years. I think I originally started following him. During the '08 during the '08 declines, he nailed that year for sure. And I remember him on watching him several times on CNBC with the late great Mark Haynes. During some pretty historic times in the market. And Scott, you nailed that year. I'm pretty sure that's when I became a fan of yours. So totally looking forward to this presentation. Are you good on the audio? Let's see. That's Scott right there. Hey, Scott, are you good on the audio? Hey.
Yep, there we go.
All right, am I good now?
Yeah,
Hello, hello, test right. Hello, hello.
You're good, Scott. Go for it.
Woohoo! I'm here. First of all, JC, thank you so much for that introduction and having me in this unbelievable just day or few days that you organize so many people that do so many different things in the market. So many different walks of life, so many different types of technicians, so many different types of market participants, and I'm just happy to be here. And I've been doing this a long time. If you want to see real quickly, I guess, first of all, here's my disclaimer. So anything I say, you cannot hold against me anywhere. But anyway, basically, I've been doing this for a long time. A lot of us have all been doing this a long time. And in order to do this a long time, you need to have a process. You need to keep your sanity. You need to basically just know what you need to do as an individual to survive the markets. And it's different for everyone, and everyone approaches it differently. So what I kind of want to do today for you, because you're going to get so much information here today, everyone who's logged in. And first of all, I commend you guys for doing it. It's Saturday. I'm sure you have wives, husbands, kids, or, lots of different things that could go on a Saturday for you, but you chose to try and better yourself by listening to individuals who have had success in the market that are able to talk about it and communicate it, because there are a lot of people out there that have had success, but not everyone could, talk about it and communicate it. So I am here, and I'm going to try and do my best to, in the next 40 minutes, which I could probably do in a week or 2 weeks, which I've done, just to let you know, I've traveled around the world really trying to teach traders a process, just trying to give them a mantra on how they could pretty much conduct themselves in order to keep their sanity, to trade the markets, to be involved, and to develop a tactical system to make themselves money as a professional prop trader, as well as some that have already done that, or some people who have never been a professional prop trader that just want to add cash flow to their other careers, or maybe they're retired and they didn't retire with as much money as they thought, so they want to add cash flow in their retirement. So there's lots of different ways to approach the market, lots of different time frames. So what I want to do is I'm not going to just give you guys very, very specific nuts and bolts, because you're going to get that from a lot of different people over the course of the next day or two. I heard JC mention he saw me on CNBC back in 2007, 2008, and basically I was just one of the few technicians when they didn't like technicians and they didn't trust technicians. And I remember Bob Pisani saying, and here's a guy that does all pure technical analysis. Everyone thinks it's voodoo, but meanwhile, there was a Head and Shoulders top back in 2007 that ignited, and all I did is try and give some measured moves along the way and keep everyone out of harm's way when we had one of the biggest corrective phases in a lot of our lives, besides obviously the tech bubble that bursted. And I guess I got the opportunity to show how technical analysis could work without opinions, because back then everyone was trying to call a bottom from probably 11,000 down to where we went sub 7,000. A lot of people blew up along the way, and a lot of those people, unfortunately, have never come back to the market because they've been so battered and bruised. They might have been battered and bruised for NASDAQ 5,000 back in 2000, and then they got battered and bruised again. So meanwhile, here we are at Dow 20,000, and a lot of them just have turned the cheek and just don't like the stock market and just will never look at it again, because another on a different level because the media is always just talking about the next potential crisis and crash, or talking about all the risks of being in the stock market, when not enough of them talk about all the reasons for all the risks of not being in the stock market, not having a 529, not having a 401k, not having things that could help you down the road, or that you can actually make money as an active proprietary trader. And what I'm typically going to go over now is some things that I do, which has given me longevity in the business, because I've been doing this, as you can see from this front page, since I think 1997, and it's all because of a process. So today I'm going to go over 10 keys to my trading success, which I also on Twitter sometimes I put out there every week or so, just to remind everyone, that you can have a X's and O's, you can have strategies, you can have ways you make money in the market, but if you're not thinking clearly and if you're not in the right place mentally, you're not going to be able to execute on your plan. I'm going to go over some moving averages that I use that are very simple, because there are a lot of smart people out there that have opinions on what the market should do, on why it should do it, or why something's happening that shouldn't happen. And meanwhile, there's definitely some simple ways to keep yourself out of trouble. I'm going to give you guys, like JC said, the Red Dog Reversal. It's not created from an old movie from college or something like that. It's a technique that's evolved over the years, that with the age of high-frequency trading, I feel like it's been very, very effective, and more effective lately because of the pushing around that algos do, at pivots when you get to key areas. I'm going to quickly just touch on, the Brexit trade and a little bit of analysis of it, and how, understanding what happened during the Brexit trade could have helped you on the post-election trade. And then I'm also going to give you the anatomy of some of the trades that triggered very recently, the patterns that were showing themselves, and how you could have got involved, did some trade management, and made some nice money. And then we'll take a quick look at where we are now, what we're going to watch out for. And between 1 through 8, with all these rules and tactics and patterns, it'll keep you prepared for whatever comes our way, because we'll deal with it as we come, because we trade real time. The markets change, the markets are always evolving, and nothing's ever the same. But what truly is the same is price action and human emotion, and that's what we do as technicians, is we measure human emotion by studying charts and studying price action. So really, I'm going to just go through these real fast, because you could look at it at your own on your own time, because I don't have a lot of time here. Is my 10 keys to trading success. First of all, for me, my most important thing is I always have a plan. For those of you that don't know me that well, I have a note called Redler All Access. It's a note that I write every day. I'm up at 4:45 in the morning, looking at what's going on overseas, seeing where the futures are, and I start writing a note that I do prepare, which is really putting my game plan on paper that I get to distribute to anyone who wants to also read it. It's part of number 2, my daily routine, and I enjoy it. I do enjoy getting up early, believe it or not. I'm a morning person. I'm out of my house at 5:30 in the morning. I'm at the ferry at 6. I'm on the ferry at 6 o'clock. At that point, writing portions of my note based on what I could do from my phone, because I need to get it all in as real time as possible. And by the time I get to my office at 6:30, I then get to log into my virtual trade floor, which is another thing that we have, where there are already a few hundred traders logged in talking about upgrades, downgrades, what they're seeing, unusual moves, and it's all part of the routine. To continue on that routine, by 7:30, if you don't know, besides sending my note to editing, because my grammar is horrible. Everyone always corrects me on Twitter, because I don't know the difference between Y-O-U-R and Y-O-U''RE. I've learned that recently, and I'm kidding. But anyway, I'm so fast, and so trying to get so much out there. By 7:30, I'm sending my note to editing, so it could then get edited and look cute to send out to anyone who pays for it for 8:30. And at that point, I go into my studio and I put together a morning call video, sometimes called the Morning Call Express. And at that point, in 5 minutes, I go over the look, the quick feel of the market, maybe what everyone's obsessing over for that day, and then a few ideas real quickly. And then once that's done, I then do a 20-minute video of a lot more thorough, a lot more detailed, which goes to Redler All Access, which has 20 to 25 different names in it. But again, that's part of my daily routine, which I enjoy, which you have to enjoy your daily routine. You do it every single day. If you don't like your daily routine, you are not going to make it in this business because you're going to be fooling yourself. So you have to like your routine, again, because you do it every day. So at this point, I don't mind writing the note, getting up early, and doing the videos. Sometimes I have a cute girl that does my co-host, sometimes not. And then all of a sudden it's 8:30. I put a chart on Twitter, usually for free because I like to give out things as well, a blueprint of maybe the S&P cash or the spiders or a few things I'm thinking of. And then by 9 o'clock, I put a microphone on and get ready for the day and start ready to trade. And on the microphone, I talk straight to the VTF that could hear me. So I'm talking while I'm trading, and I'm then also trying to tweet some things to Twitter. Everyone gets mad here and there on Twitter if they're not a member of Redler All Access to the VTF because they don't think I share enough because I only have 2 thumbs. But anyway, I do what I can. And then come 12 o'clock, I'm off to the gym to then wash off the early morning part of the day. They're getting up at 4:45, they're writing the note, they're doing the videos, they're trading, because I know that's what I need in order to give myself a refresh and a recharge so I could get back at my desk, trade from 2 o'clock to 4 o'clock. I have stops in. If I was wrong, I get stopped out. It happens. But having those stops are key just in case something crazy happens midday. And then if I miss something midday, it doesn't really matter because my mental health is a lot more important than missing something the one day a week that something might happen at lunchtime versus not being at my desk. And then I do the recap, and then...
And Scott, can I interrupt you there for a second? I just want to reiterate that point. Phil Perlman, doctor in psychology, mentioned that yesterday. Joe Fahmy mentioned it today. How important it is that mental toughness, being at your peak ability in terms of your body, both physically and mentally, right? So you're going to the gym in the middle of the day. This has been brought up several times, throughout the conference. I just wanted to kind of reiterate that point.
Listen, and I appreciate that, and I truly believe in it because I know traders that, listen, I'm the chief strategic officer. I've seen thousands and thousands of traders. Like right now we have, I think, 700 associated members to our BD, and I've seen what makes them turn into just shells of themselves. Sitting in front of that screen all day long and banging the keyboard and trading when you shouldn't be trading, you could literally drive yourself to drink, and not even on a Thursday or Saturday, like a Monday or Tuesday, which you shouldn't be doing. But anyway, you got to get up and you got to brush off the morning. Whether it's a good day or a bad day, it doesn't really matter, and you have to do what keeps you keeps your balance. And I think that's what I've had success at, and I like to go. Like I said, I travel around the world talking to traders, saying, that you have to have the balance. You can't go home even at the end of the day, and if you had a bad day, you can't be going home and getting upset with your wife, your husband, or kicking the dog, or not picking up the phone from your mom because they didn't do anything wrong. You just had a bad day, so you have to figure out what you need to do in order to brush it off because you're not identified by your P&L every single day or week. Obviously, it's good when you make money, you could buy nice things, but if you start getting too enamored with the day-to-day and you don't have things to distract you from it, you're not going to make it over time. And making it over time is the key for all of us to stay on the job and in the business. And I'm going to try and brush through these faster. But basically, again, day in, day out, that's why I say I have a blue-collar mentality. You're not going to get rich fast as a trader. I don't care what you say, how you say it. It's not the case. Every single day you have to try and net money. Every week you have to net money. Every month you have to net money. So this way it adds up. You don't want to swing for the fences. I do not swing for the fences. I do not try and hit a home run on every trade because you're going to strike out way too many times. I'd rather hit some singles, and then back off when it's not my trade. And number 4 is don't fix Monday's losses on Tuesday. All that really means is if you lose whatever your limit is on a Monday or Tuesday, don't try and make that up on a Wednesday or Thursday. Just try and be green. Just try and make a little bit back and feel good and get yourself moving forward. That goes with number 5, get small when things go wrong, meaning if you're in a rut, I was just in Fort Lauderdale, or not, I'm sorry, Boca this weekend, talking to 80 different traders, and a lot of them have got, you get into a rut. When you get in a rut, you don't get bigger, you get smaller, and all you need to do is try and get green to make your mentality feel better. So this way, once you're feeling good, you start looking at things differently, you start looking at things the way you used to look at them, you make a little bit of money, and slowly but surely, you're through that rut. Within all that, number 6, keep an even keel, meaning when things are great, don't forget about how you got there, and when things are, not going so well, you do the things to get yourself back on track. 7, always know your time frame. Lots of different time frame. You'll see in the last, 3 to 6 months, I always put that chart up there about how the bull market wins, just for those people that, might have sold during the tech bubble bursting or the financial crisis, where I try and show them, say, hey, if you put money in every single month and you were a baby boomer the day before the 1987 crash and did it every single month, you've done phenomenal. If you did it the day after the tech bubble burst or the day before and you kept doing it in the NASDAQ, Qs, or whatever it is, you did just fine. The same thing goes for, the financial crisis. I know a lot of people who thought they were really smart. Hey, I got out, a week before the financial crisis, but you know what? If you never got back in, how'd you do? Not great. We've gone pretty far since then. So know your time frame, and the macro bull market usually wins. But then if you trade for alpha, you also have to know your time frame. That all these guys out there that are saying even now, oh, with Trump it's not going to end well. It could be a month, 2 months, 3 months. All of a sudden we're going to get that 5, 10, 15, 20% pull in, which we might not, or we might. But those that can't handle being short, or stay solvent until it happens, they get pushed out. Same way a lot of these people have been saying that since 2012. I don't know how many bears we've seen since 2012 that keep saying, QE is going to end, this is going to end, that's going to end. But meanwhile, the only thing that ended really is their trading career because they had opinions and didn't watch the price action. 8, join a trading community, whichever it is. I do think, being by yourself, it's not easy. You need to have people to bounce ideas off of, whether it's our virtual trading floor, T3 Live, or anyone else's that are presenting today. And if you're not in a community, I think you're doing yourself a disservice. And that's why there are trading firms, because people need other people to not get true ideas with or conviction from, but just everyone likes to hear themselves talk. I think one of the reasons why I'm semi-successful is that I hear myself talk a lot. So if I do not execute on what I'm saying, I'm like, oh my God, I said this in the morning call, it worked, why didn't I do it? It doesn't make me feel well or good. So if all of a sudden you're talking in a community about what you're looking to do, and then everyone, participates and you don't, it gives you accountability to your actions. And then also community, sometimes, everyone is an expert on different things. So why not get some ideas from other people? And then if you look at it and you agree with it, you trade it. If you look at it, agree with it, it doesn't work, do not go after the person in the community that gave the idea, because you're the one who pushed the keys. And then number 9, I've said it a lot already about balanced, healthy life. I do triathlons, I run marathons, I do a lot of stuff for charity. That's my balance. You could play chess, checkers, read books, go for long walks, whatever it is you do something to make yourself more balanced, so you're not just wearing your P&L on your sleeve. And number 10, which I'm going to get into and show you a lot of things that happened in the past year. Every year I show patterns that repeat themselves. I've been doing these type of presentations for a while now, and every year it seems like I keep coming up with these presentations, and once I do them and then I present them, everyone's like, oh, that looks so easy and so clear now, but you really need to know why it happened, so then next time when you're in the moment, you execute on it. Because when you look back on it, it was like, oh, it's so easy to look back and see it. I'm like, no, we all traded it real time, and if you look back year after year after year, there are clues of what transpired to give you clues on how to react moving forward. And the same exact thing happened last year. So I want to quickly get into that as well. So trade the technicals, not your opinions. And in the age of social media, there are opinions flying, which I'm sure you've seen opinions all weekend long about trades, Trump's executive orders about immigration, this and that, and I can't even talk about that because I need a few days. But we're going to move on. So one of the key things that I'm going to give you on a very simplistic term is my 3 moving average rules. You can write them down. You've heard me say it. I'm sorry if you've heard this before, but basically, my 3 key moving average rules. and I'm not going to be so technical and tactical on it. The bottom line is be long above the 8 and 21-day moving average. Be long. There are so many people that have been blown out of the water that are trying to short a market, a sector, a stock that's above the 8 and 21-day moving average, and you should not do that. That means the momentum is strong. You should try and be in that. Whenever the market and the SPYs, the Qs, the Russell, whatever's above the 8 and 21-day, if you would just be in some kind of portfolio approach and not try and be precise and not use 10, 12, 14 analytics to confirm you being long, you will make money. And when the 8 and 21-day moving average breaks, you get technical. That means some momentum left. It doesn't mean the market's broken. It doesn't mean we're going to be in a bear market. It doesn't mean we're going to crash. But in order to get to the 50-day, the 100-day, the 200-day, the first thing you have to do is break the 8 and 21-day. So if you trade for momentum, cash flow, and alpha like I do for a living, if you're above the 8 and 21-day, you look for the best acting stocks that are showing relative strength. You try and hold them and then use a tier system trading around them. And I'm going to get into a few stocks that worked very well in the last month that could have been used with these simple rules and tactics as well as some price patterns. And then lastly, if you get below the 8 and 21-day and you break the 50 and the 100 and you get below the 200, which is number 3, and stays below it, you should not be investing in it. Chances are it's in a bear market. You avoid, maybe do tiny little tactical Q trades, and everyone's like, "Fred, what do you mean by a Q trade?" A Q trade is something very fast against trend, but you better love them and leave them because they could take you to the cleaners if you're not quick, because that means that trend is horrendous. So real quickly, rule number 1, which I said, if you're above the 8 and 21-day moving average, you try and be long. I know, last year it was the big debate about rates, and meanwhile you see that tight little pattern here, okay, and you see right here come January when the market got under excessive pressure, the TLTs broke out, went above 123. This is when it reclaimed the 8-day. It was already above the 21-day. Got above it, stayed above it, and right there, the trend, the TLT from 123 went all the way up to 135, which was 12 points. And then, a lot of technicians and people will tell you what you could do when the TLTs are rising, what are the sectors you could be long or short, this and that. I'm just showing you very simply. The world was trying to debate what's going to happen with rates. Let me see if I can take this thing off here. Hold on. Can I get rid of this? Just to, I don't know if it's in the way. Hold on one second. Now it's up there. Now it's over there. Okay. Well, anyway, JC, you got me over there?
I got you loud and clear. 8 and 21-day, all day, baby.
All day, rose all day. I'm kidding. You're out in San Francisco, right?
I am in beautiful Sonoma Valley, California.
There you go. Smart.
And no clouds. And just a short 3-hour drive from Tahoe.
Not in the rat race. I'm living in here in Short Hills, playing the most for the least amount of space. Okay, but anyway, back to the 8 and 21-day moving average. It broke above it in January. It went from 123 to 135. There's a lot of different ways you could look at this, a lot of different ways you could have managed this trade, but ultimately it stayed above the 8-day, never got near the 21-day. Here it got a little extended. You never really want to buy something so extended from the 8-day. I'm not going to give you like a calculated method and the pure number of it, but loose and wide. I'm a cocktail napkin technician, meaning I use things at a face value. I'm not too precise, but this was a nice trend to the upside that got a little extended. Above the 8 and 21-day, you try and be long. You don't want to be short. Same way, you go to, let's see, let me get back here. Next slide. Using the TLTs again, I want to just show you again. This was later in the year. This was October. This was before the election, before Donald Trump. This is when it broke back below the 8 and 21-day moving average, somewhere around 137. And then the TLTs, meaning rates are going to rise, were below the 21-day from about 137 all the way down to January, which was down to 119. So about, 17 points below the 21-day moving average. Lots of ways to trade that. Some people, when rates are going up, they were buying the banks. You do all your different correlations. You do all your, everything you do as a trader. I'm not going to get into all those because I don't have time. I just want to show you the trend is to the momentum to the downside below the 21-day. And when it happens to stay below the 8-day, then you really know you don't want to be long this. And then this was around election time, so there was no reason to be long the TLTs whatsoever or anything for rates going down. It was all rates going up before the election. So it started before Trump was elected. And I see JC talk all the time saying that he loves watching all the media outlets try and put a narrative on the trade because they have nothing else to write about. And a lot of the market action was well underway no matter who got elected, and then just things get intensified. But anyway, below the 8 and 21 day. So if you were short into the election just because technically it looked like a short, which I probably wouldn't have done because it was a binary event anyway, boom. Then right here, took back the 8 and 21 day. Some might have looked for a cute short. Some might have just said, okay, I'm going to cover this because there's something different going on here. And as a technician or a technical strategist, you always look for something different. Then I want to show you quickly oil, because I said you don't touch something that's below the 200 day. By the time it's below the 200 day, we're done. As active prop traders or short-term portfolio managers, the oil was below the 8 and 21 day. Probably, I don't even know, somewhere, I didn't put it on the charts, I wanted to simplify it around 100. Oil, look how oil was below the 200 day, literally from, where is this, 100, and look where the 200 day, boom, 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 all the way back to it, failed, all the way back to it. Finally, you didn't have to catch a bottom in oil because oil was 26, but you also didn't have to buy it from 100, 90, broke another bear flag at 80, came down, gave you a reflex rally, failed, rally up, failed to 26. You did not have to blow yourself up, or even as just say you allocate funds to different spots for a longer term account, you didn't have to be long oil until finally, it started acting better when it got back, I would say back above 35, and now oil's been above the 200 day now for a while now, 7-8 months. So it's finally investable. It's been investable for a while. We've covered short term. It's not the place to be for alpha and cash flow. It doesn't move that well, but just saying in general, look at the 200 day. You could also draw so many lines here as a technician. Bear flag down, bear flag down. Here, cute little trade as it took out resistance to the upside. Horizontal consolidation. You could have drawn this back, back lower and then back. So anyway, the moral of the story is here. You do not do anything for more than a Q trade that's below the 200-day moving average, and by no means is it investable until it changes. So 8 and 21 day. I'll reiterate everything after because I want to get through everything here for you. The red dog reversal, literally. JC likes to have fun with that one. It's not like the Italian stallion. I don't know if you know where Italian stallion came from for Rocky Balboa, but it wasn't made by the writers of Rocky. Red Dog Reversal. My nickname's the Red Dog. You can follow me on Twitter. My handle is Red Dog T3. It's just a strategy that it's the same thing as almost like a hammer top, a hammer bottom, a hanging tail this, a hanging tail that. I like to call it a Red Dog Reversal because I'm very narcissistic and I wanted my name in the strategy that I use a lot. Kidding. But here it is. If you want to take a snapshot, everyone sometimes like, what's the definition? What's the definition? So truly, understanding why it works is probably better than the definition, which I'm going to try and give you guys a little bit of. Okay. Basically, just say a stock is down for multiple days. That's it. A stock goes from just say a stock is going to go. So people say, hey, this stock is going to 30 and it's at 50. In order to go from 50 to 30, you got to go below 45. You got to go below 40. You got to go below 35. You got to break levels to get there. In order for a stock to be down for 4 days, that means you got to get below the day 1 low to make it a day 2. You got to get below the day low 2 to make it day low 3. Okay, so all you have are pivots to figure out, are things going to get to where you think they're going to go? Okay, can something be down 2 days, 3 days, 4 days? Sometimes it can be down 10 days. But in order to be down 10 days, you got to go and get below and stay below the 9th day. That's why I always list the pivot as the day below prior low, because that's where the tug-of-war fight is between the bulls and the bears, depending on which way you're looking at it. So here, price goes below a prior day's low. So if you're on day 2 to day 3, okay, in order to get to day 3 down, it's got to get below day 2's low. Okay, so all of a sudden now, you're in day 3, it traded below day 2's low, comes back above it. Oh my goodness, there's not a day 4 low. So that means maybe you just pull back for 3 days, you're going to bounce. So it's a way to catch a counter trend trade with the plan, because some people will buy it at day 3 down, thinking, oh, it's down 3 days, I could buy it. No, it could be down 10 days. It could be down 15 days. You could be out of business. So this trading strategy gives you a way to enter an oversold situation, with a plan where you could buy it when it trades below a prior day low, comes back above that low, you buy it at that pivot, and then you put a stop at the day's low, so this way you know where the price discovery was, where you entered, where your stop is, and then sometimes you get a nice trade. So I'm going to give you a quick example of oil. This was this year in November. Okay, go back here. 1179 was where the USO was. I'm not exactly sure where oil was at that point. So this happened to be in like October. So a month later, the USO is down, 20%. Lots of trades along the way. Oh, look what a quickie thing. It's below the 8-day and the 21-day. You're not supposed to be long anything below the 8 and 21-day, especially below the 50-day. So there was no reason to be long oil. There was no momentum in oil during that time frame. So here it's below it, below it, below it, below it. Finally, triggers below 974. What's 974? The low right here. Gets as low as 956, right? 956. So what are you risking? 22 cents, because once it crosses back above this, okay, anyone who was playing the USO to go to 9 or 8 or 7, whatever it was, because there were people saying, oh, oil's going back to the lows, blah, blah, blah. You cross back above it, so that means once you get back above it, the shorts probably need to cover, saying, oh, my goodness, it was just at 1179. Now, it might reverse for a trade, let me cover, and those who said, hey, I sold 1179, or oh, I sold when it broke below the 8 and 21 day because Red Dog said to sell this at 11 1/4. Let me try and catch a cute trade that might turn into something more. So you buy it at this pivot, you put your stop here, nice day trade, and then typically what I do on a reversal bottom, on a Red Dog reversal, is I hold at least a third for some kind of follow through, because usually if the shorts didn't cover here, they're on the ropes and they need to cover, and if you didn't buy here for a potential bottom trade and it's up, it turns into a nice trade. So this was a nice day and a half trade in oil. Just as an example, I could show you 1,000 examples of Red Dog reversals. I do it all the time, but I just wanted to show you something closer by, and I'll show you another one later in Apple. So the same way, you could do it on the opposite side. Strategy for catching a counter trend move in an overbought stock. It's a way to short a stock without trying to pick a top. It's also a way to get out of a stock that you bought lower that you might be looking for an excuse to sell. Same thing, stock is up for multiple days. In order to be up for 4 days, what do you have to do? You have to get up above the second day prior high, the third day prior high, to be up the fourth day. So that prior high, to me, is a very important pivot, and that's what the algos look at as well. So on this one, price goes above a prior high, squeezes leftover shorts that got in too early, and also people who think it's going a lot higher that chase it all of a sudden, get involved because they think it's going to the moon and comes back below that. Then all of a sudden you have your entry. I used real quickly an example here with X just to show you the mechanics. X came from a lot lower. There were a lot of people fighting this move. And then finally, this was after 1, 2, 3, 4 green days. This was your prior high of 38.19, which is your pivot. That's in my morning note. I would have said on this day, hey, X has been up, had a considerable run. You could look to take profits with a Red Dog reversal, or look to get short if it trades above a prior high, comes back below it. Well, traded above the 38.19 high. Okay, went as high as 39.14. So you were risking 95 cents, which might be a lot for some people, might not be. But basically, you're short here versus that high, and automatically you already made money by where it closed. And then right here, after a big move from the low 20s, why not take a little home for maybe a swing trade? And then from 39.14, it went all the way down to 33.17. Day 1, Red Dog reversal. Day 2 went below it. Day 3 went below it. On this day, you actually have a Red Dog reversal the other way. That could have got you to cover it, or you could have covered it whenever you wanted to book your profit to feel good. Then right here, maybe some people even reversed for a trade. So that's basically what the Red Dog reversal is. It's looking at a pivot from a prior high, looking at the rubber match between buyers and sellers to figure out if there's continuation or not. I'll get into more of that after. Real quickly, I want to talk about last year's 2 biggest moves of the market that could have really made your entire year. Every year, there are 2 or 3 or 4 spots that make a trader's year. The rest of the year, you're trying to just make a little bit of money, hit some singles, not lose too much, and not pull your hair out. If you looked at me lately, my forehead's getting really big. I'm not pulling it out, it's just receding. And you got to figure something out before I start pulling it out. But anyway, I want to talk Brexit real quickly. I'm going to get through it fast. Brexit, boom, right here. Everyone was anticipating they would stay. We were ready right by highs, 2120. Didn't happen. This move, these two bars right here, probably stopped out. I don't want to say the SHIT word, but a hell of a lot of people. This move, because it wasn't supposed to happen, crushed. I'm telling you, this crushed a lot of people that were trying to handicap a binary event, which I don't handicap binary events. I'm a trader. I'm not that smart. But anyway, this move happened, and the reaction to it, I think, was what everyone thought would happen. That happened. What happened next, though, the bounce back after the 3 days of bouncing back, this was a surprise. So right here, this was what was expected. Right here, this was what a surprise was. I know some traders here that got stopped out of their longs, somewhere within this wide range bar, and then said, hey, this is a bounce back to sell. Everyone said the world's going to end after the Brexit. I got to be short. But meanwhile, they lost money long here, and then they lost just as much money short because they had an opinion. So on these 3 days, we came right back up to the upper end of the range. So right there, you could have either been stubborn and got short here, got short there, and got blown out of the water with opinions that the world should have ended on Brexit and this move doesn't mean anything. Or you could have said, hey, look at this. We came in, we bounced back, we're back above the 21-day moving average. It was potent. Let's use some retracement rules. If this could hold the top third of this range, basically saying, hey, there's commitment to this 3-day bounce back, then you draw yourself a little descending trend line. You know what? Let me see what the next trade is. This trade we didn't see coming because we thought they were going to stay. This bounce back we thought couldn't happen because the world was supposed to end. So the next spot was your evaluation spot. This was your spot to say, hey, you know what? This is behind us. This move and this move is behind us. Let's look here at what's happening. You have your bounce back. You held the top third. You just did a red dog reversal around this pivot. Red dog taught me that if it gets below this, comes back above it, it could be good. We're in the top third of this range. If we were to break above this 2120, you could extend this. And just because I missed this bounce back that I didn't think was going to happen, I want to catch the next 80, 90 handles and make my trade. Well, that was a broader look at what happened here post-Brexit. Move lower, snap back, hard to tell what was going to happen. This was your evaluation time. It showed you commitment. What a coinky dink above the 21-day. Red Dog said don't be, short above the 21-day. Then it triggered above this descending trend line. So anyone short versus this that was short during here, they had a cover, and anyone who wanted to play the continuation, there it was. A very, very profitable time frame, and a very painful for some that wanted to listen to the media and listen to the news. In this situation, if you missed this, you could have learned from it and done a lot with it for the election. So let's talk Trump, right? The world was supposed to end if Trump got elected, and the market was supposed to be annihilated. This is what everyone said. Just you could take a quick look at it. I'm not going to, harp on it. So this was your pre-election move lower. And oh, what a quinky dink, below the 21-day from 2148 down to 2080 at 60 handles or more. Actually, more than that, right? Not fun to sit in this if you're an active trader, so there was no reason to sit with it because you were below the moving averages, so there was no momentum anyway. Plus, it also took out this level. So anyway, pre-election, the opinions are running rampant. Then what happened? Election night. He wins Florida. Futures go down, whatever they were down, 100 or so handles. And, because everyone said if Trump wins, the market's going to crash. Everyone wanted a Hillary win for the election. P.S., that night around 9 o'clock, if you follow me on Twitter, I said, if I traded S&P futures, which I don't because I'm up at 4:45, and if I traded futures all night, I'd be a shell of myself. My wife would hate me, and I'd be divorced, and I wouldn't be trading anymore because you can't be up 22 hours a day. So I decided not to trade S&P futures. So I said I would start accumulating under 2050. Just saying. There were a lot of guys that tweeted back at me saying, I'm buying here 2050 to 2030. And the reason why I said 2050, that wasn't me being a Kato napkin technician. It was because that was the biggest open interest. The option dealers actually handicapped the fact that 2050 was a spot that it would go down to on a move lower. In the same way, I think they were looking at 2150 on the upside. So anyway, that was why I didn't just throw it out there because I was drinking wine with my wife and watching the election results, which I probably was. But anyway, here you go. Pre-election sell-off. This was your response back. This was your day. We opened down 20 handles. This was the day after President Trump, or at that point, Trump-elect was there. And what did it do technically? It took out this descending trend line that was intact. That means everyone who shorted against it made money. This time, they had a cover, 2142. What also was going on here? Ooh, we reclaimed the 21-day moving average. This is the time to be long, get in portfolio approach. Now, after this snapback, let's see if there's some commitment to it, just like you saw post-Brexit. Well, ooh, look at that, a little circle. Circle above the descending trend line, above the 21-day, just went from 2082, 100 handles, had to digest. This is when you start looking for relative strength, the best acting stocks. Oh my goodness, I don't want to miss the next move because the next move should take us above the 52-week high of 2193. Here we are at 2166, so that's still 30 handles plus probably 20. That's a great trade for active traders, prop traders, for anyone in the world, to be honest. But this was, again, your analyzation spot. This was hard to tell, right? No one knew that from 20 handles to up 30 would happen when Trump was elected because everyone said the market was going to crash. It was wrong. Then here was everyone's time to take a breath and say, wow, what's going on here? And as a technician, you're digesting higher. And then look what happened. Boom. That was your digestion above the descending trend line. Then it took out 2193, up to here, came back, messed around with the 8-day, held above the 21-day, then traded above this pivot, which is important because this was the line in the sand where if you were short, you better cover. And if you're looking for continuation, that was your spot. And there you go. And let's go one more slide forward. Okay, just to, again, show you when you took back the 21-day, you didn't have to worry about who was in office, what was going to be his first 100 days. No, this is when he took out the 21-day. Then you take another look here. By being, these are the lessons. You be careful with experts claim they think is going to happen in the future. Don't assume you know what the market's going to do. Look at the technicals. And if you look here, take a step back and look at that chart. Everyone's like, oh, it looks so easy now. Well, there were signs along the way, very similar for the year. This was what everyone thought. This is what they wouldn't think. This was your analyzation. I'm having a great time with that word. This was your spot to see what's really going to happen next. And then if you weren't revenging the trade, you caught yourself 80, 90 handles. Here was pre-election sell-off, your snapback. This time it got above the descending trend line first, but hovered above it versus hovering around it. And then you look at your next move. You didn't have to know what was going to happen, who was going to be elected. From 2140, you had 100 handles higher. So a lot to learn from what transpired in 2016. In 2015, it was the year of the two double bottoms. The year before was something else. It's always going to be something, but there's always going to be a narrative based around it. So you have to read the tape, and you could use, everyone was probably using 100 other analytics. What was the MACD doing during this? What was what doing during this, et cetera, et cetera. For me, I was looking at this. The Russell was on fire. The banks were on their way. This was holding higher. I think the Russell was already at new 52-week highs, and so were the banks. So I'm like, you know what? Why isn't the S&P going to follow suit? So you connect some dots alongside with some common sense, and that helps you execute on your plan. So now we're going to get away from the broad indices. Okay? I don't know if any of you know, but every year I write a report, and I take the report and I put it together. It takes me a lot of time during December. My wife gets mad because she's Italian and I'm Jewish, and she's getting ready for Christmas Eve, and I'm sitting there trying to put together 14 to 16 potential great-looking stocks that could work out really well for us. So, oh my God, I got to get through this fast. So there are a lot of chart patterns that I put on there that triggered. Okay, the reason why I put them on there was not because I like it or I drive it like Tesla. I didn't have it on there because me and Elon Musk have drinks on Thursday nights, or because I have a Tesla. Because of this. Look at that beautiful.
You don't have drinks with Elon Musk on Thursday nights?
If I had it, I'm going to say I didn't have it with him. That's why I can't say that was my excuse for buying it, because he didn't tell me to focus on it and put it on my report. He didn't tell me to tweet it out a week before when he was on the transition team with Trump. I used a little common sense and part of my process, but the main key was this descending channel here, which you see everywhere. It happens everywhere. What does it mean? It means a stock that was doing nothing for a year that you could have shorted at the trend line every single time could start a new trend. You combine that with Musk being on the transition team, with maybe autonomous cars, electric cars getting more socially accepted, this and that. Meanwhile, this was, a trend line where if you were short and you were looking to buy it, it's done nothing for a year. Once it crosses above it, it's a great trade. So here you go, boom. That little spot also reclaimed the 50-day moving average, and here it went above it, didn't fail. That spot right there could have made your entire January. You bought right there and went on vacation, okay, great. Or you're a trader like me that's in every day, that has a blue collar mentality, has to be in the trenches. I need trade management. You want to be in it as long as it continues to work, and boom, look at that beautiful trade. What do those look like to you, to everyone watching this? I don't know how many people are on here, but lots of different bull flags, right? Stock just went from breaking the trend line, didn't break it and fell, it didn't just give you distribution after breaking the descending trend line. It gave you accumulation and then lots of trades along the way from 197 to 224 with a little red dog reversal sell signal here at 222. So maybe like, ooh, I just made some good money from here to there. Let me just pull back a little bit. Then you had a little 3-day pullback from 222 to 211, $10. Why not take a look? I got to blow through this, otherwise JC is going to kill me. You can look at it on your own. I don't know if you guys are trading Tesla, but I was long it the night those headlines came out. Everyone started bashing me. Like, hey, Red Dog, Tesla was your focus of the 2017 report. What happened here? I'm like, you know what? Maybe this is a 2016 story. Maybe if it goes green, the shorts cover and we could buy more. Let's look at it as an opportunity, not run for the hills, because on TV they're making it out as this is the biggest thing in the world, which was nothing. That was right here, by the way. It caused the biggest move of the year, and then PS it went as high as 255. So what a nice trade from breaking the descending trend line. Just want to show you descending channels are unbelievable. When you break above it and hold above it, you try and be long in a swing account, and then do trade management based on your own risk tolerance. This was the uptrend on the 15-minute chart. Alibaba I want to show you also. It was not on my 2017 report. It was my focus of 2016. But all of a sudden, look what happened here. Alibaba, from the correction, doesn't this look very similar to the descending trend line or the descending channel in Tesla? So doesn't that mean that stocks repeat themselves, patterns doesn't matter what stock you're in. So right here, if you look at it, wouldn't you be a buyer if it gets above 89 or maybe 90? Maybe this trend has changed, and boom, I remember that day. It was not the easiest trading day. That's the day you buy it. That's the day you cover your shorts. That's the day you say, hey, maybe Baba woke back up. It just consolidated, had a great year last year. They stopped selling off high beta names on anything. If you remember on this day, this is when they sold off great earnings. They didn't care. It was a different environment. Here, you buy it, you hold some. What'd you get? Woo, a little bit of follow through the next day. Great trade, great active trade. Then you want to measure commitment to it. Look at, what my editor was supposed to insert the morning note because I was supposed to beat on my chest on how I said I'm going to be buying more and I'm going to be in earnings. If you follow me on Twitter, I had call options for Baba earnings, and I was also in the stock, but I don't take stock into earnings. So right here, you had, your breaking of the trend line, your follow through, your commitment to it, another push, nice consolidation. Here I was long the stock, long the options, but I did not take the stock, so I don't take stock into earnings as part of my process and my plan. I made this actually into a call spread. I bought the 95s and then I sold the 100s just to say, hey, you know what, it's been a nice move just in case I'm wrong. I wound up working out. And then here is, Baba. And it went a little bit further. So I'm just trying to show you how patterns repeat themselves and how you don't have to be perfect, but you have to have a way to approach each and every one of these and then use trade management based on your time frame. So both of those were really nice descending channels. They both ignited and they both had commitment to being trades to stay on your plan, right? I said those 10 secrets, right? Have a plan, have a list. Well, have an A list. Well, Baba and Tesla, which were not on the A list to start the year, triggered to become go-to names. And how do people, how do stocks become go-to names? Because they trade well and they show commitment, and you could use a tier system as they make higher highs. So next thing real quick, Apple, right? Apple. I had that on the 2017 report. It's not a barn burner. Everyone was having all these different types of thoughts on what would happen this year. The iPhone 7 is not great. Google's new phone is going to be catch fire. Trump's going to be protectionist. They're not going to sell phones anymore there. Whatever. Okay. We don't trade the news. We trade technicals. This was take a step back, look at where Apple ended in 2016. So basically, when you start a year, what do you know? you know that here, this was your resistance, right? The resistance was around 118. That was that descending trend line, not as defined as Bob and Tesla. The low on the last day of December was 115.43. So if you wanted to be long Apple, hey, who knows what's Apple gonna do in 2017? Let's see if what the complexion will be. So what'd you get? A red dog reversal. So from 118 down to here, went below 114.76. Okay, went below 115.43. Put a low in 114.76. This is buy number one. Could have been your swing trade long using a red dog reversal from 118 down here. Why not try it? Your risk is defined. Okay, so your next trade, if you think about it, would be if it clears 118, right? Trade number one to start the year. Trade number two would for it to get into motion. So next trade was boom. Where you take a bigger look at it. Here's that red dog reversal. Okay, so you didn't ever have. It could have been a great day trade, and it could have been a good swing trade. It never went back below it. So the real strategy is to hold it. Then instead of selling it, you could have bought more when it cleared this descending trend line here around 118.02, cleared the pivot. Anyone who was shorted to start the year because they read different reports about what it should do in 2017, but then bam, and now we all know Apple's around 122. So that's how you use the red dog reversal. That's how you use descending trend lines to figure out how to use share management, for whatever your process is.
Scott, just to reiterate, the 8 and 21 day moving averages, these are exponential moving averages that you're choosing to use, right?
It could be either or. In the age of computers, people are using blends of both. They're not just using the simple or the exponential. It's really an area. So many times, the market's gone below the 8 and 21 day and I get stopped out, and then the next day it comes back above it and you get a little chopped up. And everyone's like, well, I'm using the 821 day. I'm losing a little bit of money on commissions and trading. I'm like, okay, but one of these times it's going to go below the 821 day, and it's going to break hard, and it's going to go to the 50, the 100, and the 200. So the few different times you have to sell it because you're looking for price discovery and get back in because it gets reclaimed.
So it's an area, and I think this gets back to when you're drawing trend lines, you want to draw it with crayons, not with pencils, right? Kind of similar sort of mentality.
Can I use that? I like that. I've never,
I didn't make it up.
You didn't make that up? You don't have it copyrighted? Okay.
No, that's definitely something I picked up from a lot of other people. I definitely didn't make that up.
Right, there's no fine line there. The computers will push you below or above the fine line to get you out of your lunch and steal it. So
it's a mattress, right? Support is not a fine line. It's more of a mattress, right? You got to give it a little bit of give, a little bit of push. And the other thing that I wanted to mention that I like that you brought up, the red dog reversal. What I love about it is, from failed moves come fast moves in the opposite direction, right? So there's a little bit of whipsaw inherently involved in your red dog reversal, right? But the most important thing, and I just talked about it in my presentation a couple hours ago, is defining your risk, right? In my opinion, the best part of the red dog reversal is that you know the risk. Your risk is perfectly well defined. You know exactly where you're getting out if you're wrong. And then in addition to that, the risk versus reward is very much skewed in your favor, right? Whether it's a red dog reversal that you're shorting or red dog reversal that you're buying, number one, the risk is well defined. Number two, it's skewed in your favor from a risk versus reward perspective. What the hell else you want?
I fully agree. And let's combine all that, because last week was such a very good example of, okay, the market was playing with the 8 and 21 day. The S&P cash was playing with it the entire week that the media said, hey, sell the inauguration, sell the inauguration. We bought the pre-election. We're selling the inauguration. First of all, no one said to buy the pre-election. That was their narrative after we already went up to where we stalled in December. So if you look here at the chart real quickly here, you have to try things a few times. Look how many times during, not last week, the week before, it was below the 8 day and testing the 21 days. You know how many times I actually sold some things? I didn't get short. I wasn't looking to short here in this. I was just like being a little careful that if maybe everyone was right and we were going to break this trend line from here, I didn't want to get caught with my pants down. I wanted to be out of the way. So many different times I was just getting out of the way. And then finally, if you remember, on Monday of this week, it broke below, and I actually got flat. I got flat on Monday, and then on Tuesday, it came back above it and then perked up above 2278. So here, I gave a presentation in Florida at Boca, and I said, listen, guys, the inauguration is behind us. This is what we know. We know that resistance is around 2277, 2288. If we get above that and stay above that, that's going to ignite a nice trade. If we get below 224, 2254, 2257, anyone who's been trying to accumulate in here for another move, they're going to get scared and they're going to sell, and then you get out of the way. So on literally this day, okay, which was the day before, it was below the 821 day. On this day, it finally got above this, closed pretty well. This was your day that if you were sitting somewhat long in tier 1 in this range, this was your day to say, hey, I'm getting long tier 2. I think that short's going to cover. We're going to get a move up. They couldn't sell the inauguration, and we're going to trade above 2277, 2284, and get a nice trade. And if you follow me on Twitter that day, I'm long the IWM. I was long the spiders. I was long Amazon. I was long Google. I was long this. I was long the most. I remember it's like, Red Dog, why are you long so much? I'm like, we just went sideways for however many weeks. Couldn't break when everyone was saying we're going to break. Even that Friday, they tried to sell it as soon as he started speaking. So now, boom, this candle right here put everything aside, got me into more size, and then I sold some, and now we've been having 2 inside days. I'm still long, not as long as I had here because some trade management, and now we'll figure out how we react on Monday after all of this, executive order stuff with the, just everything that Trump's doing this week. And I don't know how.
I love it, Scott. I hate to turn the music on, but Chris Kimball is waiting here on deck, and I just out of respect for everybody else. I mean, we could be here talking Red Dog reversals for hours, as you can imagine. How can people reach you? If they're interested in learning more about some of your products and your company at T3. What's the best way to find you?
How about this? I'm going to give them my email, my personal email, Scott, S-C-O-T-T, at T3Live.com. Scott, T's and Tom, 3 the number, live.com. If you email me and ask me and want a free month of Redler All Access, I will make sure that my team gives them 1 month. 1 month of Redler All Access.
One more time. Scott 3 Live?
No, Scott at T, the letter, you could write it in, 3 the number, live.com. That is my personal email. I'm not giving you my trade support, my customer service, my home office. I'm just giving you my email, and I will, if you take the time and you listen, I will forward it. My COO is going to be really pissed at me because we don't have the phone set up for this. But we'll make it done, and today is Sunday. By Tuesday or Wednesday, you'll be contacted, and you can get a free month of Redler All Access. And I'm hoping you read the note every single day. I put my heart and soul in it every morning. It takes me 2-3 hours. It's my 15 years of knowledge rolled up into one, and I think it could help get you prepared for every single day and connect the dots of all the other things you might use, whether it's the morning call, the recap, my Twitter. I have a private Twitter there. So email me, and I will forward them along and just give it a few days of patience that someone will get back. And if you want someone to get back to you quicker, in that email, put your phone number. Put your phone number.
I just put the email for all the attendees so that they can see that. So get in touch with Scott, guys. Obviously, I mean, you just killed it. The 8 and 21 day, excellent. The Red Dog reversal, just those 2 things alone, I mean, I think it's a huge value add to the community. Scott, I want to thank you personally, for being a part of this. I mean, it really, really means a lot to me. I think that the value that you add to the rest of the speakers, I think I don't think this would have been the same without you. So thank you for coming.
I appreciate it, and thanks for having me. And listen, this whole career and community is about building relationships and friendships. Being one with your computer screen is just not a way to go through life. It's being involved with people. It's traveling, seeing people face to face, and just evolving as a person, as a trader, because life's way too short. And thanks for having me, JC.
You got it. Hopefully we'll do it again next time. And next time I'm in New York, beer's on me for sure.
I'll hold you to that.